Right, ladies and gentlemen, we're going to get started. First of all, thank you very much for joining us today from wherever you are in the world. Today, we are going to be talking to you about how to identify the best property deals. Now, just before we get started, I just want to put a bit of context to this as to what inspired us to have a webinar entitled How to Identify the Best Property Deals. When we started the company way back in 2014, we did so more out of frustration than anything else, because time and time again, we were getting approached with clients who had bought property investments, but for one reason or another, they didn't go the way they expected. Some people had bought off plan, their projects had been delayed. Some people were told they were going to get 8% return, but actually they got 4 or 5% return. And so that's the reason why we created Opulent, to put together well-researched, credible property investment opportunities that are going to help our clients make money. Now, recently, we've started hearing this a bit more lately. And we started hearing a few more clients come to us saying they bought something here and there and it didn't go well. And so that really inspired us to put together today's webinar. We're going to take it right back to the basics. And today we're going to explain to you what you guys as property investors should be looking out for when it comes to finding your next best property investment. So that's what we're going to talk to you today about. Just a few kind of ground rules. We're going to try and keep this as brief as possible. We've got an hour to kind of whiz through it all. Of course, we're more than happy to talk to you in more detail about anything we're going to talk to you about today. Just get in touch with us, give us a call, and we're happy to speak to you. One other thing, feel free to ask us your questions right the way throughout. The chat has been enabled. If you've got any questions you'd like to ask us about anything we're talking about today or anything else, please feel free to drop that in the chat, and we'll do our best to get those answered in the Q&A session at the end. So, who am I? My name is Sanjit Dhanjal, Managing Director of the Opulent Group of Companies, and today with me is Ben Lane, who is one of our senior property consultants.
Yeah, thank you very much for having me, Sanj. And obviously, I'm speaking to you guys on a daily basis, so I'd like to give you some insights as to what I'm hearing, on a regular basis. We'll take it from there.
Thank you, Ben. So a little bit about us before we get started. We're Opulent Invest. We're an award-winning property investment company trusted by hundreds of investors from all over the world for over 10 years. And we're very highly rated on Google reviews and Trustpilot, etc. What's the agenda for today? Well, first of all, we're going to just talk a little bit about what makes a good property investment, because it would be wrong of us to talk to you about how to find good property investments without first of all talking a little bit about what is a good property investment. Then we're going to talk to you about the key criteria that we look at when we're appraising our opportunities, which are regeneration projects, population growth trends, assessing the local economy, connectivity and proximity to education establishments. Then we're going to finish off at the end with a brief discussion on what are the other things you as property investors need to be considering when trying to identify the best opportunity for you. Right at the end, we're going to have a Q&A session. So as mentioned previously, feel free to feel free to ask us your questions as we go along. So I'm just going to start a quick poll, guys. It'd be useful to know a bit more about yourself. You should see now pop up on your screen some descriptions. It'd be good if you could just let us know what description best suits yourself. Excuse me, we're a little bit bunged up today, so you might hear the odd sniffle or cough. So this first screen here is the adverts that hit myself just yesterday. So I took a screenshot of all the property investment adverts that I saw either on my mobile device or on my computer, etc., and summarize them here. What we see here is we've got investment opportunities starting at 5%. We've got some at 16%. We've got some at 14.5%. We've got some at 6%. And so how do we know as investors, which are the right deals to go for? The next screen here will also illustrate to you two investments side by side. What we've got here is a glitzier kind of skyscraper style off-plan project where prices start from 325. This particular project is in Manchester. The net yield that it delivers is 5%. and the service charges, because they're bigger buildings and have more amenities, etc., is £3.50. On the right of that, you've got another opportunity, which is something that's already built immediate income and is already tenanted. Service charges are about £2.28 per square foot per annum, and it offers an 8% net yield. Now, on the face of it, I could say that, you know, the deal on the right, if you're a property investor, is probably the best deal to go for. But how do we know that, guys? How do we know what is the right a good investment? And this is where we all need to start, because what makes a good investment for me or for Ben may not necessarily make a good investment for you. So really, the answer is going to vary according to you. And a good starting point is to, first of all, just understand what are your ultimate goals and objectives. What are you trying to achieve? What is the underlying reason behind why you came into property investment? Are you trying to build a retirement fund? Are you trying to just generate additional income? Because maybe some of your other properties with the mortgage rates going up require subsidizing? Or, you know, are you just trying to provide a better lifestyle for your family? All of these reasons are significant. And without, first of all, knowing that, you know, you're kind of, you know, shooting in the dark, really. So spend some time really just understanding what it is you're trying to achieve. And then once you know that, let us know, because we as consultants, as agents, we need to know where you want to get to, what your journey is, so that we know how best to add value to that by suggesting opportunities that meet your requirement. And kind of tied into that, everyone's goals and objectives are individual. So don't follow the crowd. This is something we go on about quite a lot, Ben.
Yeah, exactly, absolutely. Because, you know, I mean, I get clients all the time where, you know, for example, they had an uncle or a family member that bought in a certain location 10 years ago, and that investment for them has obviously worked out very, very well for them. So they think, well, I need to buy in the same place. Mm-hmm. But the thing is that obviously that's had 10 years of capital appreciation, 10 years of growth. Mm-hmm. The area might have, you know, have been, you know, either regenerated or already had its big uplift in price. Mm-hmm. So what we're about is trying to find the best locations moving forward, which wouldn't necessarily be the best location 10 years ago. Yeah. So definitely, be an individual, follow the crowd, and don't
follow the crowd.
Don't follow the crowd.
And look, it you know, as investors, a lot of the time, kind of you look for safety in numbers, and you know, you've invested in a scheme, and it makes you almost feel comfortable by getting one of your friends to invest in the scheme. But it's kind of wrong to do so, because you know, they might have different objectives, different goals. You know, the media also, you know, you see a lot of media about, you know, Manchester being the next best thing, or Liverpool being the next best thing. And you know, really, ultimately, what makes the next best thing is, you know, an investment that's going to help you achieve your long-term objectives. So beware of the bad deals as well. You know, we come across this a lot of poorly researched opportunities in areas where, you know, there's not a lot going for it, but yet you still find investors are buying into these schemes, and you know, as a result, the investment doesn't work out the way it should do. So hopefully by the end of today's webinar, you'll have some tools and some tricks to kind of get around that. Always do your research. Research is of paramount importance. We work with clients from all over the world, and it's refreshing almost to see certain clients from certain parts of the world doing the right research. I mean, I must admit, some of our investors from the UK, they're not doing as much research as what they should do. For example, we have customers from Holland or from other parts of Europe where they are really kind of doing their research. They're asking the right questions, and they're taking it upon themselves to make sure that investment is going to work well for them, rather than, you know, whoever's telling them at the other end of the phone. Finally, go with your gut feeling. This is something that I endorse heavily. But usually, if it doesn't feel right, then, you know, it's not going to be right. If it's too good to be true, then more often than not, that's what's going to happen. It's going to be too good to be true. Thank you all for answering the questions, by the way. So the first thing we're going to talk about, and perhaps the most important part behind identifying the best property deals, is by choosing the right location. Everyone bangs on about location, and rightly so. So whenever we're looking at a location, and whether or not to suggest it for our investors, the first thing we look for is regeneration. and understanding the impact of regeneration within the area within which we're going to invest. Now, what is regeneration? Simply a process of rebuilding or renewal of the common good, taking an asset from crisis and collapse to recovery and renewal. And so what we're talking about here is, if you're looking at investing into a particular area, to what extent are the council and the local council pumping in money to regenerate that area? To what extent is the economy growing? How many new businesses are opening up in that area? To what extent is population growing in that area? How many cranes can you see? How many new office blocks are going up in the area? These are all signs of regeneration, and with that comes growth, both for property prices, economic growth, etc. So regeneration is of paramount importance. 3 different types of regeneration. I won't go into these too much, but the main one we're looking at is economic regeneration. This type of regeneration aims to increase employment and business growth in the area. So why is it then that regeneration is important for us property investors? Well, first of all, regeneration, it revitalizes a particular area. When an area is revitalized, more and more employers want to come in and set up their businesses or offices there. With that comes job creation, and with job creation becomes more population. And the more people that live in a particular area, the more demand there will be for rental properties and also properties to purchase. So in a nutshell, that is it. As and when all of this money comes in and is being spent on an area, more and more people will decide to live there. And as a result, demand will increase for property prices, and prices should increase as a result. Now, as property investors, where can we go to? Where can we look for this information? Because it's all out there, guys, and it's all there ready for you to read and look and peruse in your own time. But the first place is the local council website. At the local council website, you're going to find lots of information about what their vision is, what their plan is for the next 5 years, what are the most significant regeneration projects, and then you can gauge how likely is that to affect your next investment.
Yeah, and generally just on that point, so if you do have a look at the website, look at the planning section, and especially the local plan. So every council within the United Kingdom has a local plan, and what they not only do is identify the sites which are right for large-scale regeneration, but then explain which ones are going on and what the general consensus is of an area. So that'll give you an idea of whether the area is seeing significant investment or whether it's not.
Yep, there you go. As Ben said, local planning portals. The Department of Levelling Up House and Communities, here you can find lots of information about, the Levelling Up Fund, which is, the fund that's often used to finance a lot of these regeneration projects. And then, last but not least, news outlets. There's lots of press out there around regeneration and to what extent an area is regenerating. So first and foremost, regeneration, which ties us in nicely to the next subject, which Ben's going to talk to you a little bit more about, which is analysing population growth trends.
Yeah, thank you very much, Sanjit. So population growth. So, why is population growth important to property investment? And it comes down to the very basic principles of economics, supply and demand. When there is a higher demand for the supply, then the value of an asset goes up. And that's why when you have a growing population, generally that will put upward pressure on house prices, because when there are, first of all, more people moving to an area, that puts upward pressure. But then also, again, when you look at the specific demographics, that again will help push up house prices. So, again, you need to look at kind of high growth emerging markets, focus on specific demographics. And what I mean by that is basically age profile. So if you have an area where there's, say, a lot of students or there's a lot of families, then that's very good, because you then have a large number of the population which will potentially enter the property market, not only from a rental perspective, but then also from a capital appreciation perspective. So then moving on to the next slide, where do you find this information from? So again, the Office of National Statistics, I think that is generally the main one, because every 10 years they produce census data. And then what they will then do is analysing that data and then looking at the kind of general trends across the country, that then give a more localised figure of what they predict, the population growth will be moving forward. And while sometimes it's not as accurate as the reality, the hype around an area seeing population growth will encourage investment, and that will in turn, increase population, basically population levels. And then again, you can look at, kind of local authorities like the GLA for London, local government websites, and so on and so forth. Most of this information is online and free, and you can just basically type it in for specific areas.
Absolutely. But it always amazes us how many of our investors don't actually look at this information before investing. And so if there's one bit of advice we can give to all of you today is, pay attention to what we're telling you, because all of this stuff does really help and will make you and will increase the chances of your investment being a likely success or not.
Yeah, exactly. And again, the specific demographics are very important to what kind of investment you want to make. If you are looking to rent to young professionals and students, then areas which have a high level of younger people in is definitely what you want. Whereas, for example, if you're looking at maybe a furnished holiday let investment, there may be an area where people retire to, which is better for people to go on holiday. That would be a better investment in that instance. So again, it's very much determined by what your specific requirements are. So again, this is kind of going on from what we've said before, but yeah, look at total population growth just generally, but then also the breakdown of the demographics of those particular areas. So then moving on to the next slide. So again, household size and structure, migration patterns, and then very simply, the supply versus population growth. Yeah,
absolutely. And just to reiterate, guys, if you've got any questions on anything we're talking about, feel free to drop us a question in the chat, and we'll address that when we get to the Q&A session at the end of today's webinar. So moving on to the next section, which is assessing the local economy. And this is a biggie again, tied in all of these things we're telling you to look at today. They're all interlinked in some way or another. Population growth usually comes from a thriving economy, an economy that's growing. So investors should be looking at the state of the local economy within which you're choosing to invest. It's of critical importance. Why? Because it transcends across every area of a property investment. This is something that's going to directly impact the demand for property in the area, the void rates within the area, the rental yields, the capital appreciation. All of that is going to be affected by the strength of the local economy. So it is of paramount importance to make sure that when you're investing in an area, that you do your homework on the local economy. Really what you're looking for here is, lots of businesses starting up in the area. New business startup is a good indication that an economy is growing. When the businesses come, they bring with them their people. The population is going to grow. You've got to look for a diversified economy as well, because with a diversified economy, it means that that particular area can stand up better in the face of turbulence within the economy and economic fluctuations. And also, if an area is thriving, the unemployment rate is low, the levels of disposable income is high, which means you could find a better quality of tenant, but more importantly, you're going to find tenants who can afford to pay slightly higher rents.
Yeah, exactly. Moving forward, then also, again, if you're getting people moving to an area where they can afford to pay, higher mortgages and that kind of thing, then naturally, with the demand, that drives up house prices.
Yeah, so absolutely. So once again, where can you find this information? It's all out there again, guys. Government agencies, local council websites, local authority websites. The Office of National Statistics contains all of this information. You can look at GDP figures, you can look at employment rates, population growth again, and you can really kind of get to the bottom of, who are the type of people who are going to rent these properties from me when I invest. And also, let's not forget resale, because not every investment lasts forever. There's always going to be a time where, in 4 or 5 years' time, perhaps you want to exit that investment. By investing in an area with a strong, vibrant economy, you're going to increase the possibility of being able to resell your property easily. So yeah, have a look out for this information. It's all there. Again, another good source: local chambers of commerce, Manchester Chamber of Commerce, London Chamber of Commerce. You can look at bank reports. A lot of the banks, HSBC, Bank of England, they're all writing about this stuff, and they're all releasing lots of information that we as investors should really be reading to make sure that our investments are sound. So again, strength of the local economy leading on from population growth and regeneration are all vitally important. And these are the sort of information that our sourcing team are scrutinizing when we're looking at a location or a particular project. Moving on to the next section, connectivity, also another biggie, and Ben's going to talk to you about why connectivity is important.
Yeah, exactly. So I mean, connectivity, kind of does what it says on the tin. It's basically how well connected a property in a certain area is to the wider area. We're kind of going to look at why that is important and why that will essentially give you better rents and also better increases in value. So, I mean, the big one is basically very simply accessibility. If an area is very well connected, then the potential for the types of renters that you're going to get there and the number of people moving to that area is going to be much, much higher. Because if you can, first of all, commuting wise, getting to work is incredibly important. Also, being able to kind of go out of an area, again, is incredibly important when you kind of analyze why an area is kind of very, very well connected. And when you have a look at the kind of how this does impact house prices, generally areas which are A, well connected anyway, but B, then have large infrastructure projects that's kind of tied into the regeneration, but specific ones due to connectivity, they have a massive impact on house prices. So again, the kind of big two that we've had in the United Kingdom over the past, kind of 5 to 10 years has been HS2 and also the Elizabeth line. And when you analyse the towns that are along the Elizabeth line, going into London, all those areas have seen above average value increases compared to other areas in the southeast. And then again with HS2, you're seeing kind of investors speculatively buying up land kind of around the area of the HS2 station in Birmingham. Again, that's going to have a very positive impact on house prices, which you're already seeing, but will mainly see kind of closer to the completion of that project. And then again, all these things are very much interlinked. So again, the development and economic growth, generally areas which have much better connectivity, generally attract better quality of employers, better quality of sort of people working in the area. And then also on top of that, people that are better connected generally have, a better quality of life as well. So how do you kind of analyze why an area is well connected? Well, again, I mean, my favorite way is just basically by looking at a map. So if you, get up Google Maps, look where the property is, maybe type in a few destinations that aren't too far away, see what the kind of journey time is. Also have a look and see where the nearest bus stop is to a property for kind of localized travel. Also how close the nearest train station is. And also what are the timings like, not only for the immediate area, but also areas which are a bit further away. And then also proximity to things like motorways and important
road.
Yeah, exactly, road traffic. And then also finally, international airports. And where do those airports fly to? Because again, that is a very big draw for people who, can work internationally. Also for businesses setting up in an area, they're near an airport, that gives them much more kind of scope for, scope for business internationally. So then moving on to the final point that we look for is educational establishments. Because again, if you've got, on a very simple level, lots of students in an area with a good university, that's going to have high demand for rental properties. And then again, if it's an area with good schools, that's going to attract families to the area. So again, there's going to be much higher demand when it comes to both rentals and also property value increases. So what to look for again, sort of colleges, international schools, universities, and also definitely look at the ratings of these. And if they are good schools, especially with the universities, look at the international list, see where they are on that, and also the Times Good University list as well. I think is also a good one to look at. And then again, I've obviously mentioned probably quite a lot of this already, but high graduate retention rate that puts up population growth, again putting up the pressure on house prices. Easier exits, as people generally want to buy and rent near to an education establishment, and better long-term security, because if you have lots of people that are in an area that do want to rent there, then generally you're going to get longer-term tenants in there that pay better rents, and is just generally better from an investment point of view moving forward. Is there anything you wanted to add to that?
I just wanted to home in a bit on graduate retention, actually.
Yes.
Because it's a big thing, and the number of kind of graduates being retained in an area can often have a very positive impact on the local economy, and so this is something that I always look for in my own personal investments. To really have a look at the universities, have a look at where people are coming from and what percentage of those graduates are staying on in that area, and both increasing the demand for rental properties, but also pumping money back in to the local economy. So graduate retention, I think, is a big one there.
Yeah, exactly. And this is not to say that areas that don't have universities aren't good investments by any stretch of the imagination. But if you're buying in a kind of reasonable sized city or large town in the UK that's got a university, then that will be a big factor.
Correct.
In that.
Correct. So, moving on to the next section, what you should be looking for in education. So, I mean, we've kind of talked about this in depth already, but really, locations where there's more than one university in the area is always a big help. There's places like Birmingham and other places that have got multiple universities and a high level of graduates studying in the area, and then also schools. We haven't spoke that much about schools, but schools are a big draw for people to come to an area, in particular families. But
exactly, absolutely. And where I grew up, for example, in Buckinghamshire, is a very popular area because of the grammar school system. So that kind of localized drive has meant that area has seen, again, above average property values increasing basically over the past 20 years, because people want to move to an area to get their children into good schools.
Absolutely.
And again, these are the kind of sources where you can actually see the information. So generally just looking on the internet, the Ofsted websites, and then as I said, university websites and that kind of thing.
Correct. Thank you, Ben. So we've talked about what are the key kind of points that we would consider and what investors should be considering when finding or identifying the right location. We're going to talk to you a little bit more now about, in the time that we've been in business, in all of our experience, what the points are, what the other things that investors should be looking for with their property investments. And we're going to do this in a kind of discussion format. Again, if you've got any questions, guys, based on this or anything else, drop us a question in the chat, and we'll get round to them in the Q&A session. But these are some of the things that I would say our clients come back to us and say, look, this is something we got caught out on, or this is something we maybe should have considered a bit more, but we didn't. So the first thing we're going to talk about, Ben, is service charges.
Yeah, exactly. So again, when you're buying leasehold property, generally service charge is a big consideration. So, we obviously get a lot of people who say, oh, well, it's just better buying freehold because then you don't have the service charge, which again is not necessarily actually true, because, obviously, if you own the freehold, you're then responsible for all the maintenance work. So again, when it comes to service charges, you need to basically look at, what facilities are within the building. Are there a good number of facilities that will make it attractive to rent, but are there going to be facilities that make that astronomical, in terms of the service charge moving forward. And then also how many other people are within the building as well, because obviously if you've got high-end facilities, that's great, but to make sure the service charge isn't astronomical, you probably need another 400 or 500 flats to ensure that that's the case.
Yeah, absolutely. And here's another thing on service charges, and we came across this quite a bit in the past, and I know some of our clients are still coming across it, but a lot of these blocks that are built in our space are sold to individual investors. So in other words, the developers kind of sold the apartments already, and as such, isn't managing that building on behalf of himself, and so often will give the block management to a third-party company. And because the developers in the main probably made the majority of his profit already, he may not have a vested interest in how well that kind of building is being run, so to speak. So one thing we always advise our investors of is, when you're looking at buying an apartment within an apartment block, then have a look at the historical data, the structural plans, how was the building built? Is it sound? Because if it hasn't been built correctly, or if you come across stuff like where they've taken shortcuts, or they've used timber joists in the ground instead of concrete, etc., can really have a knock-on effect to how big your service charge is going to be. And so we as a company, we're always looking at that. We're always looking at how structurally sound a building is, because if things are falling apart and hasn't been built correctly, then ultimately the investors are going to face a much bigger service charge payment, and that ultimately is going to reduce the amount of yield you can get. And so a big thing is really look at how structurally sound and secure these buildings are, because it will really save you lots of money moving forward. So service charge is a big one. Also, you really just need to look at the kind of track record of the service charges. Before you buy the property, your conveyancer, your solicitor will give you, the last 2 or 3 years budget in the service charge. Have a look at that. Have a look at how service charges have increased over time. From that, you'll also be able to spot things on, whether the building is not being managed the way it should be. So really kind of look at that information, guys, because service charges, unless you are you own a share of that freehold, which we're starting to see more and more, i.e. you own a share of the company that owns the freehold, you're kind of at the mercy of a block manager / developer. What they decide is generally what you have to abide to. So choose your blocks wisely, and even the company that's managing the block. Do some research on those guys, because again, if it's a company that doesn't manage blocks well, then you're the one who's going to be left footing the bill for that in your service charge. And
obviously, this is all applying to blocks which are already built. So if you are buying something which is off plan, then make sure you do get the information on the developers' other properties, how those were marketed, sort of before completion, and then how the service charges have increased after completion. Because we do get it a fair bit where a developer says that the service charge is going to be a certain amount, and then once the property is built, that service charge increases dramatically. So just do your research, and get proof that they don't increase them dramatically, and so on and so forth, and you'll be absolutely fine.
Absolutely. So moving on from service charges, we've got actual yield versus projected yield. Now this is another biggie, and this will very much tie into your appetite for risk, I guess, as investors, because you're seeing a lot of new build projects that are promising the world. Basically, they're projecting a 12 or 13% yield, and again, without doing the research and really understanding how they're going to get to that figure, it is only just a projection. Whereas you've got some investment opportunities that have an actual yield, i.e. they're tenanted, they're operational, the tenant's paying the rent, how how much the rent's going to be. Proven track record. And as a result, you're not likely to experience many surprises. So this is really kind of completed versus off plan. And so yeah, beware of the projected yields, because I'm starting to see nowadays, and I think this kind of ties in a little bit, Ben, with the amount of kind of assisted living opportunities we're starting to see on the market. They're kind of promising 10% returns as standard, and as a result, I'm starting to see a lot of other companies in this space just manufacturing the yield almost in some instances.
Well, no, exactly, absolutely. Because I mean, over the past year, basically, assisted living has become quite a big thing. Because obviously, the logic behind it is very, very clear. The fact that there is a lot of people that need housing within the UK that needs to be supported by the government, and obviously, since the selling off of social housing, we can't really, offer, not only people who basically need social housing, but then also, elderly people to actually be able to live within the community. And they normally offer returns of about 10 to 11%. But then when you actually analyse that and you think, well, why on earth would a local council be paying way above and beyond, the rents for social renters compared to the wider market? The thing is, they wouldn't. So you need to, and basically what we're now seeing is that a lot of developers are just basically promising that they can get similar returns when actually, when you analyse it, you'll get a lot less. So yeah, again, doing your research, looking on Rightmove, seeing what kind of rents are in an area is absolutely paramount to see whether it is realistic. And if a rent is much higher, then there should be a kind of compelling reason as to why that's higher, and how that's being achieved.
Indeed. So yeah, be careful of that. Moving on to amenities. I mean, this is kind of basic stuff again. Not trying to teach you to suck eggs here, guys, but really what we're talking about here is, and we've talked about it to some extent with regards to universities and education establishments, but how close are you to a supermarket? How close are you to the train station? How close are you to restaurants, bars, which is typically what tenants like to frequent? How long does it take to walk to these places? Really, really important, guys. Again, it almost comes across as being insulting for me to tell investors that, but you would be surprised. How many investors we speak to are buying literally projects in the middle of nowhere because they were promised 10-12% returns, etc. So yeah, have a look at your amenities and what's around the development, really. Anything to say on that, Ben?
Oh no, exactly. Just kind of reiterating what you said. As ever, this comes back to what we're saying about the connectivity. When you connect it to all these amenities, then again that improves the rentability, improves the value of the property. So it's very, very key. Absolutely.
Cladding and fire safety usually applies to buildings that are over 30 meters high. But obviously cladding is a big thing since the Grenfell disaster here in the UK. You need to be looking, if you're buying a building with cladding, whether it's kind of above 13 meters or beneath 13 meters, I would be looking in detail at the type of cladding they've used, and whether or not it meets the current standards.
Exactly. Otherwise, you just won't be able to get a mortgage on it, and the resale value will be a fraction. You won't be able to
get a mortgage. And there's another point here that I'd like to mention. Most of the reasons why you can't get a mortgage currently is if cladding exists that isn't safe on a building above 13 meters.
Yes, correct.
That's how it is for now. And so what we found is a lot of investors, my building's less than 13 meters, I don't need to worry about that. But actually, you do need to worry about that, because you can bet your house on the fact that once the government have dealt with all the buildings that are above 13 meters with cladding issues, then they're going to turn their attention to the buildings that are below 13 meters, because let's face it, it's a fire risk either way, whether it's above 13 meters or below 13 meters. So
yeah, well, and when you also consider that the ones below 13 meters will very realistically have much fewer flats within a building, then the cost per flat to get that removed will obviously be higher. So, definitely do be aware of that.
Absolutely. So, and again, a lot of this information will be available to you via your solicitors. There'll be fire safety inspections you can have a look through to make sure, the building is up to scratch from that perspective. So yeah, have a look at all of that information, guys, and have a look at whether or not the building is safe in terms of fire safety. Leasehold versus freehold. Another big one. We've kind of talked to you about a little bit about it already.
Yeah, exactly. Elements of it, and because there's benefits to buying a leasehold and there's benefits to buying a freehold. Obviously, with freehold, you have complete control. It is your property. You can do what you want with it. But as I mentioned earlier, you then have the responsibility of doing absolutely everything on that property. So if there's something that goes wrong, if you've got subsidence, you're then fitting the entire bill. Whereas if you buy a leasehold property that was either recently built or recently renovated, then generally everything's under warranty. Plus, also, when you look at the locations of freehold properties, generally within city centres, freehold properties get bought up and then converted to flats. So you get basically put into a kind of leasehold framework because, again, those are the properties that are going to be closer to the amenities, better connected, better, closer to the universities, so on and so forth. So there's pros and benefits to both properties. And look, if you're an experienced investor, I would always say you should get a mixture and diversify, and not just focus on one or the other. That's always the kind of best way. I mean, is there anything you wanted to add on that, Sam?
No, I think he summarised it very well, actually. He summarised it very well. One thing I would point out is with the leasehold and ground rents, I know ground rents have kind of been abolished now, but there are still some legacy developments where ground rent does still apply. So make sure you're kind of looking out for that. And if ground rent does apply, look, it might not be the end of the world if you have to pay ground rent. There's still investors who are happy to pay ground rent, but where it becomes an issue, and this is again something for you guys to look out for and get your solicitors to explore a bit more, is if those ground rents increase or double after every 5 years or double every 3 years even, then in 10 years from now there won't be much income left because most of it would have gone on ground rent.
No, exactly. And I mean, in fairness, I think the government, obviously, with any new build flats, you can't introduce ground rent. So the government have clamped down on these kind of rogue developers who are basically ripping everyone off. And also of these instances of people, of basically developers selling houses as leasehold and then doubling the ground rent every 2 to 3 years. So the way that you come around it, what we used to do before the abolition of ground rents, is essentially look for the ground rent to be increased every 5 to 10 years, but linked to the retail price index. Yeah. And what that means is that it can't be raised above the rate of inflation. Because I think, obviously, every 5 years being raised in line with inflation, I think is fair enough. Yeah. But if it's above and beyond that, and if there's no kind of control on that, then that's where you need to be a bit worried.
Absolutely. So I'll just put up another question, guys, just a little bit of research for us. The question is, when are you thinking of buying the next property investment? If you could let us know, that would be really good. But the final thing to point out here is short-term let potential. Now, short-term let's not for everyone, Ben. No. But, those people who are utilising it and doing it well can earn higher yields. So it's definitely worth looking at, just how much appeal the area within which you're looking to purchase your next investment has for short-term let and for short-term tenants.
Yeah, exactly. And when it comes to short-term let, essentially you generally get a much higher income. But obviously with that much higher income comes a lot more kind of paperwork and a lot more hassle kind of setting up the property. I mean, don't get me wrong, you can give it to a management company who will do everything for you, but generally you do have higher setup costs, but then you can reap the rewards at a later date. And then when you analyse areas for short-term lets, obviously areas that are popular for holidays, areas that are popular for business, but actually quite often what we've found with short-term lets is that actually there are kind of localised demands for areas that actually mean that they can outperform your more traditional areas. Because, for example, whilst, say, like Liverpool, for example, that's a very popular area for short-term lets because it's a holiday destination. People go there to see the Beatles. There's also, a certain amount of business that's been done in Liverpool. But then again, because lots of people have done that, you can say that maybe Liverpool is maybe more saturated compared to, say, smaller areas which are less well-known but have a reasonable demand but very, very limited supply. So again, it all comes back to supply and demand. That's what drives all of these things.
Absolutely, it does. And look, just to, another kind of almost misconception, as it were, is that short-term lets often, they're too much hassle. They take too much of your time. This, and we're all busy people, and it's going to, for some reason, involve more of their time.
Well, if you do it yourself. 100%. Yeah, exactly. But if you give it to a management company, you don't. That's why you just need to make sure you buy in the right area.
That's it.
Where it warrants a management company doing it.
So that's it. And there are plenty of those companies as well. Plenty of companies who will manage your properties. They'll meet tenants. They'll greet them. They'll change all the linen, the laundry on a daily basis. And so don't discount that. Again, it depends a lot on whether or not the person who's in charge of the freehold will give you permission to do so. Some buildings, some block management companies don't like short-term lets because some of the guests can be untoward or noisy, etc. Just make sure that the lease permits you to do short-term lets. So that kind of summarizes what we think you guys should be looking out for. Obviously, there's so much more. We've been investing into property now for a number of years, and there's so much more we could tell you and share with you. And by all means, if you want to learn more about anything that we've spoken about, if you want to talk to us more in depth about it, then right at the end of the webinar, there'll be an opportunity for you to book in a one-to-one consultation with one of our experts here. But here's a last few bunch of pointers for you. Speak with local agents, get a feel for the area, for the likely rental demand, and how property prices are likely to appreciate in that particular area. These portals here are very useful. Zoopla, Rightmove, On the Market, Mouse Price Home, they all contain some really, really good data for us as investors to be looking at in terms of how prices have risen, how rental prices have risen over time. Keep a lookout on those guys. Look, if you don't have the time to do all of this research and can't be bothered to do it all, then Opulent can help. This is what we do day in, day out. We've got a sourcing team that are looking at all of these different criteria on all of the projects we work on. As I mentioned earlier, we're an award-winning company, and we've sold over £1 billion worth of UK property. The power of simplicity. What we decide, we understand that a lot of investors don't have the time to get involved with furniture and management and finding tenants and so on and so on. And so what we put together was the total property investment solution. So where you can have one single point of contact, whether it be researching the property, buying the property, letting it, managing it, marketing it, or even reselling it. We can do it all for you. And we can make life easier and simpler for you by having one point of contact for any matter related to your property investment. That kind of brings us to the end of the webinar. I'm going to run you through a few of the current opportunities that we've got currently, and ones we're actively marketing to our clients. We've got a lovely brand new project in Leicester. Leicester's a very interesting area. Prices are below the national average. Lots of regeneration going on, population growth evident, and as a result, we feel that Leicester will be a good bet for our investors. Lovely off-plan project of 90 apartments, yields coming in at around 6.5% to 7%. This is an exclusive project to us as well. This is off-plan. It gets built. It's almost complete. It completes
April next year.
Completes in April next year. So very, very well advanced. This is Stafford. Again, it's not an area that immediately springs to mind as a buy-to-let destination. But once you do your homework, once you do your research and you look into Stafford, you'll find that it ticks a lot of the boxes that we've discussed today. Prices here start from as little as £107,000.
And those are genuinely below market value as well, because the developer, basically, they're parting ways. They want to sell them quickly. So they're basically selling them at the minimum price that their lender has agreed to sell them for. So they're genuinely below market value. And also those short-term let yields, 10%. So again, as I was saying about areas which you wouldn't first think of as a short-term let area, but where there's reasonable demand, but chronic undersupply in terms of being able to service that. So you get some of the best short-term net yields in the country.
Absolutely. So that's Stafford, another great opportunity. Here's a project we're marketing in London, in just the outskirts of London, with great access into London. Prices here start from £277,000 now. You'd be hard pushed to get a property in Manchester for that now.
One example, in some of the new build properties we get in Manchester, one beds starting from 350,000, whereas we've got one beds here starting for about 295, 277 for the studios, and obviously you can get a train line within half an hour to one of the major economic centres of the world. So it's very, very good location. Absolutely.
And then finally, we do get involved quite a lot with student accommodation units, which are basically PBSA, purpose-built student accommodation, situated very close to universities. They're often quite small, 15, 16 square meters in size. They have a desk, a bed, and everything a student needs, really, to have the perfect home away from home during their academic times. Prices on these start from as little as 45,000 actually, and they go up to about 65,000. It's a great kind of entry level product for investors. So we also have a few opportunities like that available. So we're going to move to the Q&A now. But before I do so, I'm just going to publish our free one-to-one consultation. If you'd like to book a free consultation with one of our consultants, by all means, feel free to do so. You should have those up. You should have that up on your screen now. But yeah, let's jump into to some of the questions.
Yeah, exactly. Well, we've got one here from Sally. Basically, should I be wary of any property with a 10% net yield or above?
Great question, Sally. Great question.
Yeah, exactly. Again, I'll start. So again, with properties that offer 10%, obviously that has got to be one of the things that you do look at and go, how is that realistic? Is there an underlying reason why that property would be able to generate 10%? So again, it's not a case of one size fits all. You see a high return and immediately think, oh no, it's a scam or that kind of thing. But basically speak to the consultant, understand, is the background story realistic? How are they doing it? Ask for the data, on how that's been generated. Because, for example, with one of the properties that we've got at the moment, we've got one with 10% net yield.
Yep.
But when you actually analyse how much the entire site is generating, you realise that actually it's a fraction of that, and it's a very realistic return.
Absolutely. And I guess the answer to that also comes down to everything we've shared with you today, Sally, i.e., do your homework, do your research, look into all of the stuff we've mentioned today, and you'll kind of begin to form a picture yourself as to whether or not that's a genuine 10% return or not.
Yeah, exactly, absolutely. But then again, sometimes, if it was maybe, say, an off-plan student accommodation where, is a really high-end, expensive student, they're offering 10% net for 3 years, have a look in that area to see how realistic those student accommodation rentals are, because quite often they'll be overselling the value of the flat and then subsidizing the rents after. So again, do your research and you'll be fine.
Good. Thanks for that, Sally. We have another question here from Saeed. Saeed has asked, do we need to satisfy all of these criteria to be able to go ahead with an investment or not? And that is a fantastic question, by the way, Saeed. Do you want to start on that?
Yeah, of course, absolutely. So again, there's not going to be one property that satisfies every criteria whatsoever. So, again, those 5 things that we were talking about just in terms of the location, the regeneration and all of that, it doesn't necessarily have to have all 5 of those to be a good investment.
Yeah.
Again, with every property, there's a story, there's an angle that you can look at to see whether it is a good investment or not. So again, the one I was talking about with the location, if you're doing short-term lets in a holiday area, to be honest, generally places where people go on holiday aren't going to be the best connected. They're going to have much older populations, but it doesn't necessarily mean that it's a bad investment if you're doing holiday rentals in that location. Is there anything else you wanted to add to that?
No, I think it's spot on. I mean, like you said, it's going to be difficult to find a project that meets every single criteria. I would say again, go with your gut feel. You will know, and you will feel that this investment is right for you based on what you have been able to find out about it. It doesn't need to be all singing all day. It doesn't need to be satisfying each and every criteria. It doesn't.
And also, in fact, if there is one that satisfies every criteria, it's a brand spanking new building, massive, and then it's generating 10% net returns and all that. That's actually probably when your alarm bell should start ringing. If it's absolutely perfect from every point of view, it just doesn't exist. So.
Absolutely.
And then also just very quickly, with I think a few people have been asking this just about the slides and also whether there'll be a recording of this webinar. So yes, it will all be recorded and put on our YouTube channel. And then if you send us your emails, we can also email you that particular slides, which I know some of the initial, Janil, I think has done as well.
Yeah.
And then another question as well, I think from Janil as well. Should you finance a purchase with cash or with a bank loan? So again, a very good question. So again, it comes down to personal criteria and what is basically best for you and what you're looking to achieve. So again, if you're maybe slightly older and you're looking to basically supplement your income, then generally getting a mortgage can be quite difficult, because obviously if you're of a certain age, you wouldn't be able to get a mortgage. But then also, if you're looking to supplement income, then generally pushing aside a load of your rental income for mortgage repayments probably isn't the best course of action. Whereas if you buy something that's maybe cheaper cash but giving you a higher return, then that would be a better option. But then again, if you're looking at, say, longer term growth where you don't need to supplement your income, but you're looking, maybe early in your property journey, you're looking to build up a portfolio, then obviously leveraging, putting down deposits of 25 to 30%, pushing, giving a reasonable chunk of that income towards the mortgage repayments, and then basically seeing the proper appreciation through the capital growth. Because what you should do is really be remortgaging, not every 2 years, I think that's too regular, but every 5 years, you can then take money out of that, put that down on another property, and then that's how you kind of build a portfolio. So again, whether it's better to purchase with cash or bank loan, again, is very much determined by your personal circumstance and what you're looking to achieve.
Yeah, and let's not forget the Bank of England base rate, right? Because if the interest rate is very, very high, like it has been, for the last few years, then it may not make sense to buy with a mortgage. The rental income that you receive may not be sufficient enough to even cover your mortgage if rates are high. So keep your eyes peeled on that as well.
Yeah, exactly. But then also, again, one thing that we have seen over the past 2 years is when the interest rates have been very, very high, is that people have been buying in cash. And then now they've had those 2 years of basically not only appreciation, but also when interest rates are incredibly high, that means rents massively increase because less people are buying property. So those people who bought in cash can now take equity out of the property. The property's worth more, and they've had 2 years of very, very good income with a much higher rent yield than what they would have started with.
Absolutely. But look, I mean, more specifically, if you are new to investing, or you only have maybe 1 or 2 properties under your belt, then taking finance is a great way to speed up the rate of acquirement or acquiring more properties and building your portfolio. So yeah, definitely bear that in mind. But that's a wrap, guys. Thank you very much for joining us today. Thank you for wherever you've joined us from. We love doing these kind of webinars and speaking to you guys. As discussed, if any of you want any more information, want to discuss any of our properties in more detail, feel free to get in touch.
Yeah, exactly. And please book the one-to-one consultations, because, we'll be happy to answer your questions. And again, as we said at the start, with property investing, it's about your specific requirements and finding what's best for you. So let's have a chat and see if we can be of help.
Thank you all. Look forward to seeing you again on our next one.